As we see the government set to cut back on certain entitlement programs, more specifically Medicare and Social Security, to list just two, let us now maintain the chakra level, stay in the right meridian, form one mastermind, and let's go over powerful ways and means to do for ourselves, such that we don't have to depend on these so-called government entitlement programs. Because the key in life is to be independent versus dependent. Now, if a cheap stock doesn't have quality and real potential, well, it's not a bargain, it's just a low-priced piece of garbage. Now, the best inexpensive stocks to consider actualizing for future monetization are never sure things. There are many stocks out there that are under $10 right now that deserve to be there and will only get cheaper. Why? Because they are pieces of garbage. However, keep in mind that share value is all relative amongst cheap stocks as well as expensive stocks. For instance, Amazon is worth about $1,133 a share right now. However, what will make it go up or down? Surely not its size alone, but rather its growth potential and Wall Street sentiment on the stock. The same is true for the best inexpensive stocks as well. You see, you simply have to look deeper, family members and listeners alike, than the share price and explore the fundamentals and future growth potential of that particular company and that particular stock. Now, yes, some picks have fallen from great heights. Case in point is GE, Sears, JCPenney, okay? But the only thing that matters is where they go from here, not whether they ever get back to all-time highs from a decade ago. Now, staying objective is indeed the point, and very important. Leave emotion out of it. And you should always do your own research. Trust but verify. But if you're looking for the best inexpensive stocks to actualize or buy to open right now, yours truly has done the homework, so you'll pass the test. I've got a few of them here that I'd like to present to you. First one is AgroFresh. AgroFresh, symbol AGFS. That's AGFS. Now, as of Monday, and all of these prices, and I'm about to give you, are the prices of the stock as of the close of the market on Monday, December the 4th. Okay, this past Monday, 2017. Now, AgroFresh, symbol AGFS. As of Monday, it was trading for less than $5.89 per share. Now, this particular position is one of the best inexpensive stocks to consider actualizing or buying to open right now. Okay? And this particular stock is a play on society's increased demand for healthier eating. AgroFresh specializes in technologies to keep produce like apples and avocados fresh and attractive to customers. Now, considering how once seasonal fruits and veggies are in continuous demand in every geography, this is a no-brainer investment no matter what the price. But with shares well under $10 a share, and with AGFS posting a brisk 15% revenue growth in its latest earnings, this is a lock for any trader and investor looking for cheap stocks to actualize or buy to open at this particular time. AgroFresh, symbol AGFS. Next is the Royal Bank of Scotland, symbol RBS. Share price as of December the 4th, Monday, 2017 was less than $7.48 a share. Now, the Royal Bank of Scotland, symbol RBS, may sound like a crazy position to be on my list, okay, of the best inexpensive stocks to actualize or buy to open right now, given the risk of the Brexit and the continued anemic growth in the UK and the nearby Eurozone. However, listen to me closely. Keep in mind that getting a nearly $40 billion bank for under $7 a share, okay, at present prices is a rare occurrence. And last time we saw massive banks like this trade at bargains, patient investors made a killing. Think about Bank of America, which traded for $7 or so as recently as 2012, as investors shunned the stock in the wake of the financial crisis and continued troubles. Now Bank of America trades for $12 a share. Now, RBS provides the same potential opportunity, beloved family members, as we see now with others see eventually, for patient and determined ASK THE WIZ Wealth Institute family members, as its shares are trading for just 60% of book value. Royal Bank of Scotland, symbol RBS. Next position I want to give you is Every Holdings, spelled EVERI, Every Holdings, symbol EVRI. Now, as of Monday, it was trading for less than $7.72 a share. Now, this company was formerly known as Global Cash Access Holdings, Global Cash Access Holdings. And it's a Nevada-based company that produces slot machines and services to casinos. Now, in 2017, hopes of a cyclical recovery backed up by strong consumer spending numbers has led to high hopes for this segment of the entertainment and leisure sector. Shares of EVRI have soared 200% year to date, but remain around $7 a share. Now, EVRI continues to be one of the best cheap positions to consider for actualization or buying open at this particular time. Now, after impressive first quarter earnings that included 16% revenue growth, analysts have recently raised their price target on this particular gaming stock, and they expect it to go much higher. Every Holding, symbol EVRI. Next position I want to give you is Kinross Gold. Kinross Gold, symbol KGC. Share price as of Monday, less than $4.03 a share. Now, Kinross Gold, symbol KGC, is a little bit risky. But what cheap stock isn't an aggressive investment in and of itself? Now, while gold prices have struggled to find traction in a risk-on environment, we have seen the U.S. dollar weaken recently and a bit of fear creep in after Republican economic policies have run into a wall and as geopolitical unrest has continued. Now, listen, if we see a market correction or an increase in uncertainty across the summer of next year, gold prices and KGC stock will benefit nicely. And unlike a junior miner without much room for error, Kinross, once again the symbol KGC, is a $6 billion company with much better access to credit and capital. So don't worry about it imploding because of short-term volatility in gold prices. It has staying power. Shares of KGC are up 50% year to date and could continue to run much higher. Kinross Gold, symbol KGC. Next position I want to give you, that's trading for less than $10, was trading for $4.05, or a little bit less as of Monday, is Harmonic, which trades under the symbol HLIT. Harmonic Inc., which trades under the symbol HLIT. Now let me tell you about Harmonic. Harmonic is a video and audio systems company that helps digital media companies and traditional broadcast outlets process and produce their content. Now, as podcasts and streaming videos become the norm, HLIT services are increasingly in demand, particularly as the video and sound bites of an intensely partisan media environment are difficult to ignore. HLIT is scheduled to turn a profit of just 6 cents per share this year. But that's much better than previous fiscal years in the end, where it was in the red. And if predictions hold, HLIT will post 32 cents in earnings per share next year, more than a 5 times growth factor. Now, as American consumers increasingly use alternative media sources and those digital outlets try to meet demand with audio and video, Harmonic should see continued growth in 2018 and beyond. That makes HLIT one of the best cheap stocks to consider for actualizing and future monetization in your portfolio. Next position is Community Health System, symbol CYH. Community Health System, symbol CYH. Now, as of Monday, it was trading for less than $4.15 per share. Now, this stock has been in a downward trend somewhat. But in case Community Health System's short-term pressure shouldn't scare investors off the long-term potential in this particular case. Yes, revenue remains under pressure, and rhetoric out of Washington regarding cuts in Medicare, which I just mentioned earlier, are weighing heavily on this hospital sector and this hospital operator. However, listen to me. Revenue declines aren't because of poor operations, but rather strategic divestitures of 30 hospitals as part of a debt reduction strategy. This result, if projection holds, will be fiscal year 2018 earnings that are roughly profits this year, thanks to organizational efficiencies. Now, I don't believe Congress is dumb enough to completely cut all Medicare spending. No, it'd be mass chaos in the street, okay, in opposition. And I don't believe Wall Street is being realistic about the future of community health system, symbol CYH, after the short-term pressure on revenue as operations shrink. Now, there are certainly pressures on the company, okay, which used to be the largest for-profit hospital operator in America. But let me tell you something. CYH also has long-term potential for bold investors who see now what others see eventually. Next position is BlackRock Capital Investments, symbol BKCC. As of Monday, it was trading for less than $6.55 per share. Now, BKCC, talking about that BlackRock Capital Investments, is not to be confused with the $67 billion parent investment management company, BlackRock. You see, the smaller and more focused BKCC is a business development company, a BDC, that provides loans to short and mid-sized firms. And the regular payments on the debt can provide for a juicy returns revenue stream and fuel big dividends. Now, right now, the company pays more than 9% in annual yield based on an 18-cent quarterly payout. The risk is that those dividends could be cut, as they were reduced from 21 cents per share in 2016 to the current levels, and even that 21 cents payday was down from 26 cents per share back in 2014. And of course, there's always a risk of share declines if companies BKCC lends to can't make good on that debt. But a mammoth dividend yield and a great brand like BlackRock are reasons to give this cheap position the benefit of the doubt. Furthermore, if you believe in an economic expansion, then more mid-sized companies will look to expand and tap into BlackRock Capital to fuel that growth. Remember, BlackRock Capital is a business development company, a BDC. Next position I want to give you is Avon Products, symbol AVP. That's right, the old Avon. Now, as of Monday, December the 4th, this particular position was trading for less than $2.08 per share. Let's break down Avon. Now, as I indicated, their symbol is AVP. Now, Avon is hardly the powerful cosmetic brand it once was. But remember, many cheap stocks are often cheap for a reason, as they've fallen from previous highs. Okay? Just because Avon trades for under $4 a share, as I speak, doesn't mean it's doomed. Rather, it just means that investors need to get realistic about what to expect. And frankly, it's realistic to expect a nice double-digit gain from here, from AVP, even if the company doesn't revisit 2013 levels when the stock was trading for over $20 a share. And like I said, Monday it was trading for less than $2.08 a share. That's because AVP is expected to grow revenues over the next couple of years, even if it's only in the low single digits. And because earnings are set to sour from just 4 cents per share last year to 22 cents per share in fiscal 2017, and then 36 cents in 2018, people that are intelligent and savvy investors are starting to notice Avon and their turnaround efforts. Now, like I said, sure, Avon stock has indeed fallen on hard times, but this is one of the best cheap positions to consider for actualization and future monetization upon completion of the appropriate drill down, now based on its current valuation and outlook. Okay? Avon. symbol AVP. You've just been given 8 positions, all of which sell for less than $10.